Hey guys, hope you're having a great day. Welcome back to the Financial Fox channel. My name is Bob, and today we'll be talking about the top 4 mistakes beginners make in the stock market. I remember back in high school, I was completely obsessed with the stock market, but I didn't know how to get involved with it. I always thought to myself, man, you have to be probably really rich or wealthy to even invest. This is where the first mistake happens with new investors. Please do not wait or waste time thinking about investing. The sooner you do invest, the better off you'll be, especially when it comes to compounding interest. With all of these investing apps and competitive firms, you don't have to have a lot of money at all to get started. All of this competition is great for all investors, including beginners. Nowadays, the majority of brokers have a $0 minimum. That's right, I said zero. So if you want to just invest $100 with a brokerage, you can. Sometimes people will say to you, oh, you have to have a ton of money in order to invest, or they might say the $1,000 threshold is where you want to be at. And it's not even worth depositing anything less. Please do not listen to them. There's no barrier blocking anybody from investing, so please do not wait, just invest. The second mistake most beginners make in the market is listening to everybody else. It seems like everybody loves talking about the stock market. From the experts you hear on TV to your Uncle Joe, they all have opinions. These opinions are mostly about hot stocks that you have to invest in right now and you'll get rich. And they will also talk about the hot stocks to sell too. Again, do not listen to them. Always do your own research. Researching companies is extremely important when it comes to investing. It is time consuming, but it is well worth it. When I mention researching companies, I mean to look at the company's financials. Before you invest into any company, there's a couple questions you have to ask yourself. Are they profitable? Do they have short or long-term debts? Do they have cash on the books? Are they growing or are they staying stagnant? All of these questions can be answered by income statements and balance sheets of those companies. By doing all of this in-depth research, you will make smart investment decisions. Be aware, there's a lot of scam artists out there in the market trying to tell you the get-rich-quick schemes. And if it was so easy, why wouldn't everybody be doing it? The third mistake that a lot of new investors make in the market is trying to time the market. When I first started to study some companies in the market, I would focus on their stock price movement. And in other words, I was speculating. Now remember, speculating is not always the best idea when it comes to investing. Let's just say just because a stock was at $100 last year and now the stock is at $50 this year doesn't always mean it's on sale. What if something drastically happened to their business? Did they take away their dividend? Are they going bankrupt? These are some of the questions you have to ask yourself. So buying low and selling high is the name of the game, but guessing correctly is not easily done. Majority of the time, if you're a new investor, you'll get all emotional when you're up on a stock. And that's when you want to keep on buying more shares. When in reality, you might want to be holding the shares or think about selling the shares if that stock price gets too overvalued. And it's vice versa. You'll want to sell your shares if your share prices drop 5 or 10%. If you truly believe in the company, you should be buying more of the stocks because it's on a sale. Studies show that time in the market always beats timing the market. Last but not least, the fourth mistake that most beginners make in the stock market is not paying off high debt before investing. So you hear about the stock market and everybody's making just a ton of money every single day. You start getting a bad case of FOMO, in other words, fear of missing out. So you hurry up, open an account and start investing right away, which is great, but I wouldn't start doing this until you would start paying off all of your high debts like credit card bills, student loans, personal loans, etc. And if you think about it, the average stock market return is 7% each year. If your high interest rate debts are higher than 7%, it really doesn't make any sense at all to start investing. You're really just paying yourself first. So when you pay these high interest rate debts off, it's like you're making a return from yourself instead of the stock market. For example, if your credit card interest rate is at 20% each month and you decide to pay off your credit card, it's like you're really making a 20% return on your money. Leave a comment and tell me which mistakes you made when you were a beginner in the stock market. I hope I informed you all about some mistakes to avoid if you're a beginner in the stock market. As always, thank you very much for watching. Please subscribe and don't forget to hit that like button.